also hello to everyone on YouTube. This is a webinar about essential finance for new business, and whether you're starting up a new business, already set up a business, but like so many businesses have not really sure of the figures day to day, you're not alone. Or joining us on a refresh and refocus, we're pleased you've taken time out of your day to join us. Just to let you know, I'm Vicky, and I'm delighted to be working with the Kent and Medway Growth Hub to provide this free programme of events available to all Kent businesses. The Growth Hub is funded by the UK government and provides information and business support, including financial support. To keep up to date with the programme of events, if you go to the Eventbrite and click on the follow of the Kent and Medway Growth Hub events, then you'll keep up to date, and every new event that comes in, you'll be able to get notification of that. And what I shall do now is introduce our guest. Today's session is about helping you feel more in control of your business finance and learning how to avoid common mistakes that could trip you up. Our guest speaker today is Kent-based chartered financial planner who works closely with new and established businesses on building financial resilience and confidence. I am delighted to welcome Oliver Seacombe from Penton's Financial Planners.
Good morning. Okay, I'm just going to share the presentation and then I'll get cracking. Thank you, Vicky. Okay, so hopefully everyone can see that. So I suppose today we're going to run through, as mentioned, essential finance for new businesses. And in terms of the scenario, as mentioned, I'm Oliver Seacombe. I'm a chartered financial planner, and also in terms of expertise in terms of running businesses, I've been an operations director for a number of years, and also transitioning to managing director of Penton's Financial Planners over the next 12 months. What we're going to try and hit today in terms of things to cover is give you the confidence to manage your finances, in terms of provide some tools to supercharge your management, eliminate the need for is where possible, and highlight some resources that you may find helpful in the future. We're going to cover off 6 sections today, so hopefully in terms of breaking things down, we'll be able to do understanding financial basics, budgeting and forecasting, managing cash flow, financing your business, tax and compliance, and then lastly covering off long-term financial planning. So there's a few areas there. Hopefully the relevant bits will come up at the right time for yourselves, but obviously if you've got any questions, pop them in the Q&A. As mentioned, I've been working as a director since 2018 and working in financial services since 2011, working with businesses hopefully like yourselves in terms of providing services and sort of delivering solutions for clients. So section 1, understanding financial basics. So this may be teaching you to suck eggs in a way with the first ones, or hopefully none of this is absolutely new to you. But the main areas, I suppose, in terms of the standard phrases that we use, we've got revenue, which is the total income generated by your business, expenses, so these are costs incurred in running your business. You've got your profit, which is your revenue minus your expenses, cash flow, which is not anything to do with profit, but purely the amount of money that you've got in and out of your business. And then one of the most important ones in there, break-even point. So when your total revenue equals your total expenses, hopefully we can all exceed that and therefore start to get into that profit area. But those are sort of the basic terms. Obviously, there's a myriad of terms that are out there in terms of finances, but we're going to concentrate mainly on these 5 today and how to make these work for us. And even profitable businesses face challenges. So things like cash flow, is very important to be managed properly. Otherwise, we can find ourselves in issues. I suppose let's quickly cover off the different structures of business, because some of these will face different challenges at different times. So we'll quickly cover the pros and cons of each, just so we can understand that, and then potentially you're already fitting into one of these and or looking to transition into another in the future. So where quite a lot of people may start, sole trader. So we've got simple and easy to set up, full control over decisions and profits, and low reporting requirements. But I suppose the absolute biggest potential con is the unlimited liability. So if things go wrong, it can cost you your own assets as well as the business assets. Harder to raise finance because you haven't got an entity to sort of borrow against, and potentially less credibility with clients if you're running it as a sole trader in comparison to a limited company, for example, or a partnership. Partnership is much like a sole trader, but that includes doing it with more than just yourself. So you get the shared responsibility, still taxed as personal income like it would be if you were a sole trader, but it is easy to set up and flexible, much like the sole trader, an unlimited liability there again. This is shared between the partners, but still an unlimited liability. Potential for dispute between partners is obviously a scenario if you're working with others and shared profits, but hopefully by working in a partnership, you'll be able to accelerate those profits rather than working on your own. Limited company. So the big advantage here is the limited liability. So being able to protect your own personal assets and not be on the hook if things go wrong, and you need to declare the business bankrupt. More credibility and potential tax benefits. So working with a limited company for some people is far more advantageous or far more favourable, and potentially managing your personal income and business income can be favourable from a tax perspective, and being able to control when income is distributed. One of the massive disadvantages is running a limited company comes with a lot of paperwork and a lot of compliance. So constant need to file with the company's house and HMRC. Profits are in the business and not owned by you directly. But as I said earlier, that gives you an element of control about distribution as well. And directors still have a legal responsibility, although they aren't necessarily up on the hook for the liability side of things. There is still a legal responsibility for the directors to be very aware of. Limited liability partnership. So this is a partnership basically with all the advantages, all the advantages in terms of the limited company scenario. So limited liability it is in there, but in terms of it being it is more flexible than a limited company, but the profits are taxed as personal income, a lot like a partnership as well. You may see this used a lot with companies like solicitors, for example, where they want to remain a partnership, but they want to reduce their liability in terms of personal assets. And then community interest companies as our last one, which is effectively a business that is established with the endeavours to create something for social enterprise. The big advantage here potentially is that they would be more favourable for things like grants and funding, and again, a limited liability on the individuals there. The big difference here is where they fall into regulated entities to ensure community benefit. There is a limited ability to draw from them, so they're not necessarily going to be able to remunerate the owners of the business in the same way as a normal limited company. One of the most important things is keeping records, keeping diligent records, and there are must-haves for all businesses. So when we think about the basics here, you must keep income and sales records, so invoices, receipts, cash sales. You must keep expense reports, expense records, so bills, receipts, and supplier invoices, bank statements, tax records. So if you're eligible to pay VAT or nominated yourself, then VAT returns, corporation tax and PAYE records, and then payroll records if employing staff. So also there's legal and compliance records. So if you're a limited company, for example, you'd have a certificate of corporation or a partnership agreement if you've got a partnership, contracts and agreements with suppliers, clients and employees must be kept, insurance policies, so inevitably public liability and professional indemnity are going to be things that you may need for your business, so maintaining those, and then keeping company records and shareholder records if a limited company. In terms of how long you must keep records, so as a sole trader or partnership, 5 years after the tax deadline of the 31st of January. So that's the shortest in terms of the records here in comparison to limited companies that need to keep it for 6 years from the end of their financial year, and then VAT records for 6 years, and then payroll. So if you're employing people, then 3 years from the end of the tax year. What we will do is we'll cover off some of the other deadlines in section 5 as well. So I suppose section 2, budgeting and forecasting. So this is an area that is very important, and in terms of the budgeting, it's a roadmap for your business. It shows where your money is coming from and where it's going. So forecasting is looking ahead and estimating your income and expenses over time. Both are crucial for making informed decisions. You can do this with a simple spreadsheet or tools that manage it online, for example, or in the cloud, that can help to manage things effectively. So businesses need to be budgeting and forecasting to provide financial control and direction, help manage cash flow, which is our section 3, effectively, and identify risks and opportunities early, and support decision making and growth, which is ultimately what we're all here for, is to try and grow our businesses. So I suppose creating a business budget is absolutely paramount for any new business, and maintaining a business budget is obviously important for those that have been at the game a little bit longer. So step 1, identify your income sources. So we have sales revenue, we have grants, loans or investments potentially, and then other income. So maybe your business has some property or is subletting, so it may have rental income or other side revenue in terms of other income coming in. Step 2 would be to establish your fixed costs. So these are costs that, regardless of how well your business is doing in terms of selling, that you'd effectively be on the hook for. So things like your rent or cost of a building, and utilities, salaries and wages for staff are a fixed cost potentially, and then insurance and subscriptions that you'll pay for annually or monthly that are required to run your business. So those things that we mentioned earlier, like public liability, for example. Step 3, that is the list your variable costs. So these are the things that aren't necessarily in terms of routine costs that you'll pay every month, but are subject to you selling. So when we think about that, that would be our inventory and raw materials. If you're selling physical things, shipping and delivery, if they're physical, and then getting your name out there. So marketing and advertising, for example, are all variable costs that we can somewhat control, depending on how well business is going and how much we've got available to us. Step 4, this is relevant from a cash flow point of view, is set aside for contingencies. So making sure you have an emergency fund for unexpected costs. So ensuring that you don't run yourself too tight to the margin and leave yourself with nothing to provide flexibility. And then step 5, review and adjust regularly. So there is no point in having a budget and then just blindly following it, because things will morph quite quickly. So monthly or quarterly budget reviews are paramount to ensure that your business is continuing to meet expectations in terms of how it's performing, and adjust to market conditions, importantly. So don't leave yourself in a situation where you don't understand the circumstances you find yourself in, and your business hopefully will morph quite quickly. Your expectations will change, and you need your budget to reflect that. Okay, so forecasting revenue and expenses. So there's many ways to sort of forecast forward, and obviously I've used some nice little pictures there to sort of give us an indication of which ones are which. So historical trends, so forecasting how much your revenue will be based on previous performance of yourselves or businesses that are similar to yourself, and then looking at market research, so industry trends and competitor analysis is important, especially if you're establishing yourself in a market where maybe there's a lot of competition, or you've got a lot of information to be able to indicate where that market's going. And then what is effectively the crystal ball is scenario planning. So considering your circumstances, looking at the best case or the worst case scenario, and establishing sort of the margin for error there, importantly. So hoping for the good, planning for the bad, and then sort of hopefully meeting somewhere in the middle in terms of circumstances. Expense forecasting. Obviously, when we look at the 5 steps previously, fixed costs as a projection should be relatively easy. Obviously, there are things that change. So your rent could change, or if we think back to the autumn budget, for example, we've seen salary conditions change, and as of the 1st of April, we're going to see higher costs associated with employing people, and national living wage going up, for example, as scenarios where they can increase, but they're more predictable. Variable cost trends. So this can be dependent on how much your business is selling in terms of revenue, but also it may be considerate of seasonality and availability, importantly. So if you work in a market where costs can change depending on the circumstances at the time, then you may have to factor that in depending on how much your business sells at certain periods of time. And then your planned investment, so marketing, something that a lot of people try to do themselves, and you can keep it relatively cost effective if you're taking on that responsibility, but investing in marketing can be a huge advantage. So committing financially to that is important, and something that you should forecast for. Hiring costs, again, something you can try and control yourself, but naturally taking on an employee is a huge endeavor, and purchasing equipment for your business. So For some people, that may be as simple as a laptop, and then for others, it might be machinery or plant or something more significant. So, planning for that investment in your business could be have a huge differential between different businesses, but still be an important part of the process. And then break-even analysis. So this is the bit where you have to establish with that revenue forecasting and the expense forecasting, you've got to work out at what point you think your business will effectively become profitable. And that should give you your run-in in terms of business, and show you whether that's going to happen anytime soon or whether it's already happening, importantly, which would be very good. And then if you've got a run-in before you become profitable, you need to make sure that you've got contingency to cover that. And that's where the cash flow will come in potentially in the next section. So common pitfalls, how to avoid them: overestimating revenue. So we can all be guilty of trying to overestimate our ability to sell our product, or be overconfident in what we can provide. So we've got to be realistic. Make sure that you understand the seasonal fluctuations of your business. So I work in financial services, and we are just about to hit the end of the tax year. So everyone's frantically trying to put their ISA allowances in before the 5th of April, for example. So we have a seasonal fluctuation at the moment, and it would be reckless of us to use our March inflows as a representation for the whole year. And you can have that businesses that are only profitable during the summer, for example, holiday lets and things like that are very subject to seasonal fluctuation. Not accounting for hidden costs, though tax, legal fees, maintenance of property or machinery, for example, are all costs that you have to factor in. Otherwise, they will just catch you out, and if you fail to plan for them, will potentially be a devastating cost. Failing to monitor and adjust. So this comes back to the point about budgeting and then reviewing it frequently. So consider the real records, use your historical data to influence what you're planning to do, and compare your actual results versus what you budgeted for. If you got it right the first time, you may be able to have a good estimation of what's going on in the future. And if you don't get it right, importantly, you need to adjust your expectations. So compare your actual results against your what you predicted. And then underestimating cash flow needs. Profitable doesn't mean liquid. If you're spending all of that money or extracting it from the business, then potentially the business won't be liquid if it's constantly having to push that money back into the business, or it's being extracted. The main solution, as mentioned, using rolling forecasts, so update your budget regularly, is the point to reiterate there. I suppose one important thing to consider is, surprisingly, when looking at research, British owners were likely to manage their finances themselves, with 51% stating that they handled their own accounts using paper records, and 23% outsourced to an external party, and only 17% use software. So there are a lot of people still doing this effectively in Excel or on paper. But one of the amazing things was that British owners, in comparison to their European counterparts, had the best knowledge of tax regulation and compliance, with just 14% saying that they found it a challenge to understand it, which is significantly lower than the 20% in Germany, 19% in Italy, and 15% in France. So it appears that although our regulation and budgeting processes can be quite onerous, they are, in terms of understanding, business owners are keeping quite ahead of the curve in that regard compared to the European counterparts. Okay, so I suppose in the resources, I've put a few little bits in there, and then one of the first things that in terms of exercises, we've got 3 today. Budgeting for success. So if you want to take a minute and look at in the resources, you'll see that we've done effectively the four key areas that we've mentioned. So revenue, fixed expenses, variable expenses, and projected profit. So we've got those 4 areas there. If you can't establish these numbers quickly, then you may need a resource that can put them at your fingertips is the key message here. Because in terms of maintaining a nimble business, having these 4 bits of information to hand can be very helpful. Some people predict them on a monthly, a quarterly, or an annual basis, but knowing your figures can be paramount. So I'll give you sort of 30 seconds to think if you can pull that information readily to hand, and whether you would be able to fill this out quite quickly. Okay, so I suppose if you can't just pluck those figures out of thin air, then maybe you need a resource that can help you. And I suppose in the world we live in today, where the cost of employees is rising, and the fact that employing people is a significant outlay, and staying small and nimble can be really helpful, and implementing software that can potentially help us can be a massive advantage. And here we can see a few of the various sort of available resources that are out there for specifically budgeting and forecasting, that may be able to help. Each one obviously has its own advantages and disadvantages, but you may have seen the adverts for companies like QuickBooks and Xero on telly all the time. They're big players in this world, but they help you to firstly establish your expenses and your income, and then allow you to then utilize that information and keep diligent records, and subsequently use that towards your budgeting and forecasting. So although there's sort of the 6 different ones there, for example, or 5 if you consider Xero as part of the Zoho books, I suppose this may be dictated by, if you work with an accountant, they prefer using a certain type of software, or you may implement it on your own, just so that you can keep good records. Using ChatGPT to provide templates, for example, is a great resource. But please bear in mind that ChatGPT is not up to date. It is normally working a year behind. So when we think about tax records and changes following a budget, for example, it may not be able to be as intuitive in comparison to sourcing information live from a website or following a significant announcement. But in the world we live in today, trying to utilize AI and push forward in terms of saving time, reducing human error, and improve financial decision making is paramount. And you may not want to use all of them. You may only use one resource, one AI resource, for example. But if you can save time, it can be a huge help, and potentially reduce cost, importantly, and save you having to have a finance department, for example, when you can implement something like Zero and get that running things so that you can keep things nice and nimble and effective. Okay, so section 3, managing cash flow. So this is a follow-on effectively from budgeting and forecasting. When we think about this as a scenario, it's the lifeblood of your business. Monitoring your cash flow on a regular basis, potentially weekly, is absolutely paramount. Things like Zero and QuickBooks can simplify this process. And if you're, say, for example, you've earned £10,000 in revenue, but you've got £12,000 in expenses in a week, if you only review this quarterly, you could be in trouble quite quickly. So trying to automate this part of your business is probably the easiest part to automate, and the cash flow software has revolutionized this area, and continues to be a huge innovative area. You can manage everything in one place, and potentially your invoicing, your reconciliation, your accounting feedback, and your confirmation in terms of what you need to declare to the HMRC can all be done in that one place, saving you duplication, saving you the need to print stuff out, and saving and potentially being able to send things like invoices directly to clients via email, rather than getting another third party software on top of that. So in terms of the bits we want to cover off, as I mentioned earlier in section 2, profit is what you make on paper, but cash flow is what's actually in the bank. So in terms of your circumstances, you want to make sure that there's money in the bank to pay the bills, and ultimately your business can be doing a lot of sales and business with people, but if you've got nothing in the bank, you can't pay the bills, then things can go wrong quite quickly. Common cash flow challenges, late customer payments. So if you're sailing close to the wind, clients paying you late can have a huge impact on you. Unexpected expenses, so back to what we were mentioning earlier about legal fees or unexpected tax bills, seasonal fluctuations again, in sales can have a huge effect. So planning for those, over trading, so growing too fast, so ultimately not having enough in the bank to be able to cover the costs and that disparity between selling something and the invoice being paid potentially. Okay, so tools and strategies for healthy cash flow. So number 1, forecast cash flow regularly. So this comes back to the point in the budgeting and forecasting. Use a cash flow forecast to plan inflows and outflows. So when we think about something like Zero, they can automate this quite quickly and provide you with inflows and outflow predictions within the business. Get paid faster. So instantaneous payment is obviously the ideal world, but if you have to work on invoice terms, try and shorten your invoice terms to make sure you get paid quicker. Automate your invoicing and reminders to push people to pay, and pay efficiently and effectively. And potentially, if you can manage it within your cash flow, and you need that early payment, offer incentives for early payment. Control your outflows is number 3. So if you're working with a supplier regularly, you may be able to negotiate better terms, or potentially delay payment to them in in terms of negotiation, delay payment to them to allow you to manage that cash flow position, delay non-essential expenses, so potentially pay you when you know your tax liability, you don't necessarily have to pay it instantaneously. So although you may be working from tax year, you may not have to make that payment until the 31st of January, for example. So although it is an essential expenditure, it's worth make sure you work within the terms you've got. Avoid tying up too much cash in stock. So again, try not to over resource the business in that regard, and just ensure that you've got the capacity to be able to repurchase stock quickly if you're not gonna hold too much. And we mentioned it earlier, but aim for 3 to 6 months of operating expenses in savings so that you've got a cash reserve. So this is the making sure you have an emergency provision and income available for contingency, so that you know that if you have something go against you, that you've got the capacity to be able to cover that with your cash reserve. And number 5, use business finance wisely. So we've got a section on raising finance, and for example, you may be able to have credit lines, or you might have invoice financing, for example, that can cover short-term gaps if the business is running very low on cash flow. That may be the difference for you in terms of being able to maintain a comfortable balance for the business. Okay, so a quick little exercise here. So imagine your biggest client delays their payment by 30 days. So what steps could you take to ensure your business stays financially stable? So list a couple of 2 or 3 ideas. So I suppose the questions here is, have you got liquidity in your business to absorb this delay? Have you got that emergency provision in place? Have you got 3 to 6 months worth of expenditure that would be able to cover that eventuality? Point 5 on the last slide, short-term finance options. So have you got a line of credit that's already available, or do you need to establish something to protect yourself from those eventualities? And hopefully you'll never have to use them, but having them ready for you so that it doesn't become a panic. Is your portfolio of clients diverse enough to reduce the strain? So if 90% of your business comes from one source, you may find yourself in a very difficult scenario. If you have your net cast wide, for example, and you've got lots and lots of clients, then obviously one client not paying it will have less of an effect. And is that client a risk in the future to your stability? So will this client continue to be difficult? Is an important question, because continued late payment may be an issue if they're your biggest client. So three potential solutions: negotiate 50% upfront payment from the client in future transactions. So ensuring that in terms of the position you find yourself in, you're not putting yourself under undue stress there. You're making sure that you've got some of it covered, and if they persist, then obviously at least you've got the 50% upfront payment to tide you over. Use invoice financing. So this is again about that short-term financing options, and bridge that 30-day gap so that you've got the liquidity there. Naturally, it will come at a cost, but if it allows you to maintain your cash flow and push forward with your business, then that cost is a necessary evil in terms of the situation. And then last but not least, it sounds like I'm banging a drum for the AI software here, but switch to a cash flow forecast. So plan for future expenses better. Something again that those accounting softwares can do for you, so that you can effectively try and predict these variabilities and look for trends in the process. When you're just starting out, that can be more difficult to establish trends, but the more mature your business becomes, the more predictable those trends will become. Okay, so when we think about cash flow, naturally, things like Xero and QuickBooks from section 2 are um, are invaluable in this scenario, but there are other bits of software that if Xero isn't covering all the bases, that might be able to help. So, for example, if you have a lot of expenses that you need to process, you can use something like Dext or Expensify that can scan your receipts. It can pre-load the categorization of them and potentially reconcile those expenses into a bit of software like Xero, for example. So that, in terms of a process, can save you time. It can allow you to effectively live transact in terms of reconciliation and give you the ability to effectively not have to carry around a wedge of receipts in your wallet or purse constantly, to then just dump on your accountant's desk when you come to tax year end. So these can help in terms of digitizing your business and allow you to streamline in that regard. Cash flow forecasting, as I mentioned, Xero and QuickBooks do have this capability, but if you wanted something much more advanced and sort of pushing the boundary a bit more and trying to interrogate a bit closer in terms of scenario planning, something like Fathom or Float would be able to help you with that. And then I suppose in terms of the big things that can potentially help in terms of getting money through the door, invoicing and payments. So Square, Stripe, we've potentially all used them when we've gone to get our hair cut or in shops, for example. But all of these can help us in terms of instantaneous payment or quick payment. And normally, in terms of the process, they have payment integration and invoicing. They can be linked to other software, and something like Go Cardless, for example, if you're looking to do direct debits and one-off payments, for example, would be a useful resource to establish those regular payments. Obviously, they all come with some charges, but if you're managing to reduce your hours spent on those areas, sort of the nominal 20p cost, for example, for a Stripe transaction, maybe the difference between having to employ someone to do your reconciliation and accounting and not being able to automate it could make a significant difference. Okay, so let's quickly move on to section 4. So in section 3, we were covering the potential need for financing. So we were talking about short-term options, but most businesses will need funding at some stage in terms of the longer-term vision. So nearly every business is normally started with personal financing, so bootstrapping, for example, but finding the right funding options is important and hopefully will help you reach your goals and allow you to grow. So when we look here, for some people, it might be the number one in terms of the overview of funding options. As I mentioned, bootstrapping. This may be personally, so you might be increasing the mortgage on your property. Not everyone uses the bank of mum and dad to buy their own home. Sometimes they do it because they're trying to start a business and they want to be supported in that, and your family want to support you, for example. So this might be loans from family, and yeah, in that regard, you can control that. You're not getting into a contract with someone per se if you're self-funding or you're borrowing from friends and family. You may still have a contract with them if you're borrowing from people, but it won't be on potentially unfavourable terms. So that can be a huge help. I suppose looking at option 2, this is where you start to get into the formality in terms of borrowing. So business loans. So we've all used credit facilities in the past. We've all used bank loans potentially in the past, but for businesses, you can get things like Funding Circle, where you can get government-backed loans or business terms for a business loan. If you've got a limited company, then it can borrow directly. So I suppose the main advantage of a business loan over some of the other options is obviously you're just borrowing, so you're not giving away any of your capital, so you retain full business ownership. Normally it's on fixed repayment terms, but there's interest costs and eligibility criteria with that. So if you're a fledgling business with limited accounting history, you may not get the terms that you consider favourable, or that a more mature business might be able to attract. So it might come at a significant additional cost, for example. Then you've got grants and government support. So this is an area that doesn't necessarily need repayment. So it can be a huge boon for a business in terms of getting funding. Encourages innovation and job creation because it normally comes with a certain requirement, but they can be highly competitive. And then the last one, investors. So you may be doing this for more than just money. It may be for experience, but access to large capital and expertise, no loan repayments, potentially, and dilution. The big disadvantage here is potentially dilution of ownership. And this, as mentioned there, this can be anything from something like an angel investor, venture capitalist, crowdfunding, or just a private investor. So you might be sharing the benefit with friends or family, for example, but that will result in shared decision making. So I suppose if we're trying to raise money, obviously bootstrapping aside, then we need to prepare for that. So no one's going to lend you a business or a person if they can't provide some form of credibility, and they can't provide some information to give those people that are buying in or lending the assurance that they need. So the most important things to have available to you are a business plan, so a clear vision, market analysis, and potentially a revenue model. So back to our budgeting and cash flow there. Financial statements, so a history of your profit and loss, your balance sheet, and your cash flow forecast. As I mentioned earlier, the more records you have, that potentially the more favourable your terms will be, because you can provide greater assurances. A credit score and history, be it personal or as a business, strong personal and business credit ratings can be a huge advantage, and a use of funds importantly. So Very rarely are you going to be able to attract funding if you're just going to spend it on anything you like that doesn't provide any advantage to the business. So normally they want a reason for the borrowing, and they want to see that it's got a purpose and that it's going to importantly drive growth within the business. Otherwise, what's the point? I suppose the tips for securing funding on the right hand side there are: know your numbers. So yeah, be clear. Choose the right option. So match the funding type to the business need. Don't go in looking for a loan on plant and machinery if you're not going to spend it on that, because potentially that will upset the lender. Prepare for a strong pitch. So especially if you're seeking investors, they'll want justification, they'll want a clear vision. So make sure you're ready for that. We've all seen Dragon's Den. We all know how ruthless they can be in terms of how they interrogate the people that go on to Dragon's Den. So expect nothing less. And if you can see that if they can see that you've got all those figures to hand, then they're going to be far more likely to support you or help you than if you've got none of it. We know all the car crash scenarios where in Dragon's Den people have gone on and they go, "Oh, sorry, I don't know that number," and then they just get ripped to shreds. So don't be that person. Demonstrate repayment ability. So yeah, cash flow. Show that you've got the ability and the forecast to be able to increase that revenue and increase that cash flow, so that although you're increasing your cost in terms of repayment terms, you've got the ability to pay that off and leverage the opportunities that are out there in terms of government schemes. So look for those grants, accept that they're going to be competitive, but still try and look for those options that potentially make a huge difference in terms of not having to repay the capital, but invest in the future of the business. I suppose when we're thinking about the financing options, you've got to ask yourself some important questions. So I suppose, are you happy, or are you happy sharing the business, or do you want to be the sole owner of the business? Some people are happy calling themselves out in the sense of saying that they're not comfortable sharing the responsibility. They want to be in ultimate control, and they're not prepared to allow other parties into the business, whereas others may be actively looking for this, especially when you think about point 3 there. Do you need additional expertise? So most of the people that go on programs like Dragon's Den aren't necessarily looking for financing. They're looking for experts to support them and help them in their journey. So in that regard, it may not be a financial decision entirely. It might be about the business improving and having the expertise to call upon. And I suppose some people are wanting to accelerate the growth of their business significantly, and some people are very comfortable running a modest business. So what are you comfortable with? I've always been very open and honest with people about the fact that I never envisaged being a managing director and having to look after staff and taking that responsibility. But here I find myself 15 years into my career exactly in that position. So we went through modest growth. We didn't try and accelerate it exponentially, but you still find yourself in that position, and do you want that responsibility, I suppose, is the important question. And do you need to release capital from the business in the short to medium term? So if if you've borrowed significantly from friends or family, it might be a case that they need that money back. So do you need to find alternative sources of financing to replace the financing that you already have in place? Do you need to find another business partner, for example, because of the fact that you've got debt to service, and they'll be able to provide that capital, for example? So I think these are all very important questions we have to ask ourselves as business owners when we come to these decisions. Okay, so when we think about financing options, I suppose the one that can potentially be sort of the hardest to fully get our heads around would be business grants. Business loans are much like personal loans, just related to a sort of business enterprise, but grants are potentially a big advantage here. So grants, as mentioned, non-repayable funds given to businesses for specific purposes. So there's a number of areas that you can look for grants. The types of UK business grants that we see. So we've got government grants, so innovative UK grants, so funding for research, development and innovation. Every government is always trying to push certain areas and certain industries. So this provides them with the opportunity to fund those specific areas. Startup loans, so low interest loans with mentoring support. And then Kent and Medway Growth Hub being one, but local and regional grants. So government funded support, and many councils offer small business finance funding. So Kent and Medway Growth Hub is a very typical scenario here, where they have a page dedicated to grants that you can look up for region-specific stuff. And then industry-specific grants, though, the UK research and innovation funding for startups, for example, or green grants. So if you work in a business that's considered eco-friendly, you can look to gain funding from the Green Business Fund. And then there's a couple of charitable resources or backed resources like the Prince's Trust and the British Business Bank, for example, that will help for younger entrepreneurs or support startups, for example, which can be a really helpful way for young people to get grants and get started. Okay, so as I mentioned earlier, the criteria can be quite onerous and the competition can be high. So some of the most important things to do when you're considering grants is research the eligibility criteria. There's no point in going for something that you would never win. So make sure that you do hit the eligibility criteria, otherwise you're just wasting your time. Prepare a strong business plan. Be very clear on the impact that that grant could have on your business. So most grants are about job creation, innovation, or sustainability. So make sure that you can demonstrate that impact clearly, that you've got a very clear message and vision for those funds, and that you've tied them together perfectly, and yeah, meet the deadline. Due to the competition, they're not going to extend it when they've got maybe thousands of applications for a grant. So make sure that you get your application in early and that you've got a thorough business plan there. So you've got the grant tool in terms of where to find UK grants, the official UK grant database on the gov.uk website, local growth hubs. So again, Kent and Medway Growth Hub, Innovative UK, smart grants, and then the last tip, combine grants with other funding sources. So just because you're getting grants doesn't mean that you can't also borrow to accelerate that growth, if that's what you're looking for, obviously. So try and make sure that you're utilising all the resources available to you. Just because you get a grant, it doesn't mean that you can't also borrow funds as well. Okay, so the final takeaways from section 4, and what we'll do is we'll have a quick break after this. So explore all the funding options and choose wisely. Keep finances organised to improve credibility, and always have a repayment or exit strategy. So yeah, reiterating all the points we've mentioned before, ensure that you're ready. And then Kent and Medway Growth Hub is there to help with local with finding local grants. It has a dedicated page, so go visit that. And let's hit section 5. So I suppose this is an area, tax and compliance. This is an area that naturally we help businesses with quite a lot, but accountants can be really helpful here. I suppose the 3 most important things here are, first and foremost, avoid penalties. So late filing, incorrect tax returns can result in penalties, and subsequently these will escalate if you continue to get it wrong. So it's really important that you manage these appropriately, and then along the same vein, stay legally compliant. So the HMRC in Companies House, for limited companies, you have an obligation to them to provide certain information and to sort of disclose your annual returns, etc., to the HMRC. So staying compliant is one of the most important things around sort of business management, and then hopefully better financial planning. So knowing your tax liabilities, and managing that within your cash flow, and back to our point earlier, having no unexpected costs suddenly arising can be a huge advantage. So from that point of view, hopefully with better financial planning, you can plan ahead quite comfortably. So I suppose in terms of the business tax obligations, there's 5 key areas that you have to consider. Not all of these apply to everybody, but income tax, which is paid by sole traders and partnerships, paid on profits via self-assessment. So in that regard, when we think about that as a liability, as I think I mentioned earlier, your tax year ends on the 5th of April, for example, but you don't necessarily have the liability arise until the 31st of January the following year. And for anyone that's a sole trader that's been around more than 1 tax year, you'll have your payments on account. So you'll have the 31st of January where you'll pay your first payment, and then in July you'll have your second payment on account, because the HMRC want to try and make sure that you're paying in advance, so that the liability isn't too big when the 31st of January comes around the following year. Corporation tax for limited companies, so between 19% and 25% for businesses on profit. So naturally businesses have business expenses, but if your business is making profits, then you will pay between 19 and 25% VAT. So if a business turns over more than £90,000, then you will have to declare for paying VAT, unless your business is exempt from VAT. So this is an area that ourselves as financial planners, for example, is a VAT exempt process, intermediation financial planning. So we're not subject to VAT, but for businesses that turn over more than £90,000 an hour, are charged at 20%. And the thing with that is you have to pay it quarterly. When you consider that as a task, that's in terms of obligation and responsibility, having to do a return 4 times a year is quite a bit more than, for example, doing an annual return. PAYE and national insurance. So if you've got employees, then naturally you're going to be doing a payroll for them. So that you may, depending on your pay period, if you're doing monthly, for example, doing it at the end of the month, then you'll need to pay the national insurance and income tax liabilities before the 22nd of the month, the following month. If you're doing it by electronic payment, and if you've got employees that you would have to have an auto enrolment scheme for pension. So potentially you're making deductions for pension and submitting them on behalf of the employees as well. So that's all responsibilities that fall potentially monthly or more regularly if you run a more frequent payroll. Other things to factor in when we're considering PAYE national insurance is, as mentioned earlier, national minimum wage increases happen on the 1st of April every year. And also, for every employed individual you have in the business, you would need to provide them with an annual declaration of their income, which is the P60, by the 31st of March every year as well. 31st of May. And then the last one, business rates. So businesses with a physical premises have to pay business rates. If you're a small business, you may get exemptions, for example, from business rates, so you might not have to pay that. But if you've got a property that exceeds the minimum allowances, then obviously you'll have business rates to pay. One thing to mention, as a little aside, I know I mentioned that a business is automatically due to pay VAT if they're over £90,000 in turnover, but a business can, if they're under £90,000 in turnover, they can voluntarily register to give them the ability to reclaim VAT on expenses, for example. So where your business may have a high level of VATable expenses, you may wish to declare and voluntarily register for VAT on your own sales, so that you can claim the VAT expenses on your expenditure. So some of these I think we've covered. I covered just a minute ago. So the key compliance deadlines. So self-assessment tax return for sole traders, partners, and directors is the 31st of January online. If you want to do it via paper, then you have to get it in by 31st of October. In terms of annual accounts and corporation tax returns, you've got 12 months after the financial year end for the corporation tax return, and company's house annual accounts 9 months after your financial year end. So if your financial year end is the 31st of March, you need to have your company house annual accounts in by the 31st of December. VAT returns quarterly, payroll submissions, RTI submissions, so real-time information submitted on or before payday. So if you're paying on the 25th of every month, for example, you need to make sure that your payroll and RTI is all done before that, but the tax liability will fall after that in the following month. So you don't have to pay the national insurance and income tax for until the 22nd of the following month. Confirmation statement. So this is for limited companies in terms of confirming that they're still trading, is at least annually. So depending on when you first registered the business, you will have to submit a confirmation statement annually from that point onwards. Okay, so penalties. So one thing we don't want to be doing is getting on the wrong side of the HMRC, because they love doling out penalties. So here is, for example, the potential costs for a business for not meeting their requirements. So if you fail to submit your annual accounts, you have effectively an escalating penalty based on how long it takes you to submit them. And then confirmation statement, if you don't submit your statement in time, you get £150 fine, and then you continue to get fined, and then potentially you'll be struck off as a business and have to cease trading if you don't provide your confirmation statement. And then corporation tax, you don't get a fine, but you get interest on your unpaid tax. So although you may have a small liability that can quickly escalate if you haven't paid your corporation tax within a timely manner. So yeah, so missing deadlines will lead to HMRC penalties. Incorrect records can result in some of those issues, and as mentioned earlier, you must keep records for certain periods. So receipts and invoices for 6 years. If you use 6 years as a rule of thumb, then you should have all your information for that period. And then setting aside tax. So although, for example, if you're a sole trader, your tax year ends on the 5th of April, you don't have to pay the liability until the 31st of January, or on account, keeping that money aside so that it doesn't suddenly disappear, or you've suddenly got to find it in January before the tax liability arises. If you keep it set aside, then you know that you've got it available. That doesn't mean that that money has to just sit there and be dormant. You can still utilize it in the sense of trying to get a good rate of interest on it, or potentially looking to make that money work a bit harder for you, putting it into something like a notice account, because you know you're going to need that at a certain point, or even putting it away in a fixed term deposit for 6 months or 9 months, for example, may be a really helpful way to gain some interest on that cash. If you're just worried about leaving it in a low interest savings account, for example, you can still make that money work for you, even if you set it aside. And I suppose it's the tax compliance that is really one of the main drivers why people work with professionals like accountants and financial advisors or planners. So nobody wants their business to be fined. Nobody wants to be on the wrong side of the HMRC with that sort of black mark on them. And ultimately, the easiest way to avoid this is to work with someone like an accountant. They can take on the responsibility of doing your tax returns on your behalf and your self-assessment if you're a director or sole trader. They can do the VAT registration and payroll management for you, and ensure that you meet those regular deadlines. And in addition to that, obviously they can look to provide you with advice. They can look to seek out strategies that can make your business more tax efficient. So rather than just looking to make the most profitable business, they might be able to highlight some opportunities to improve or increase your spending to minimise your corporation tax liability, for example, or your income tax liability. Working with financial planners, obviously we've got long-term financial planning in mind. We may be able to help with things like the auto-enrolment and looking at exit plans and planning for your personal life as well as your professional life. I suppose my big tip is, even if you manage your own accounts, an annual tax review with a professional can save you money. So as I mentioned, trying to look for those tax efficiencies. There's a stat that if you submit your information to the HMRC via an agency, so an accountant, it is expected to be 4 times less likely to be investigated by the HMRC than if you submit it yourself, on the basis that the accountants effectively professionally insure themselves and take responsibility for that submission. Therefore, the HMRC are less likely to interrogate or investigate that information. When we have that in mind, ultimately, that although accountants come at a cost, it might be, in terms of peace of mind and assurance, absolutely worth it in that regard. So thinking about sort of the final takeaways, using accounting software. So again, Xero, QuickBooks, for example, help automate the processes and help highlight the liabilities. All accountants now can work on the other side of software like that. So you provide the information, you can reconcile, use things like the receipt reconciliation software, for example, and then rather than proverbially dumping all your receipts on the accountant's desk at the end of the tax year, it's already nice and tidy and hopefully keeps your bill down in terms of the cost to the accountants as well. And yeah, plan ahead for tax bills. So as mentioned earlier, keep a separate account, try and make it work for you still in terms of creating interest, etc. But always set aside that tax liability to make sure it's covered, and stay updated. We have a budget every 6 months. Sometimes we have emergency budgets, as we famously saw by Kwasi Kwarteng. But ultimately, the rules change quite frequently, at least annually, inevitably when we think about payroll. So it's important to stay ahead of that curve in terms of information, and then hopefully nothing will catch you out. In terms of resources that we have potentially available to us as business owners, HMRC online services, for example, they have their own payroll processor, but also VAT, PAYE, and corporation tax management is all done through there. Things like TaxCalc can help you with tax calculations and submissions. QuickBooks Xero, as mentioned previously, Blue Dot does tracks VAT and compliance in that regard. And if you want to automate your payroll or HR functions, things like BrightPay. So it gives you the ability to offer a framework that your employees can engage with, and obviously gives you the capacity to be able to do your payroll process through that, keep it as automated as possible, and minimize the disruption to your business. Okay, last section. We've got an exercise after this, just a quick exercise. So hopefully we'll get time to run through that as well. But section 6, long-term financial planning. So why does this matter? I suppose importantly, it ensures financial stability and resilience, supports business growth and expansion, prepares for unexpected challenges, and one of the most important things is that 60% of businesses fail due to poor financial planning. So when we think of that, when we have that in mind, if we get good financial planning in place from a business perspective, then hopefully we'll be able to avoid that as an issue. So as mentioned previously, it's sort of reiterating the point here, maintain a cash reserve. So building financial resilience is all about maintaining these areas, but the cash reserve as an emergency fund to help cover unexpected costs is paramount. And in terms of building resilience, that's paramount. Diversify your income streams. So when we looked at that exercise earlier, if you have a heavy reliance on one business, that's naturally going to have a huge impact on your business if they delay payment, or in the worst case scenario, no longer want to be a client of yours. So the more diversified your income streams, the less of an impact that will potentially have on your business. Some businesses may only have one type of product or service, but potentially the more services you can offer, the more markets you can reach, and the more products that you can distribute, the more resilient potentially you can be in terms of diversifying your income streams. When we consider section 4 and the funding options, control your debt and improve your credit worthiness. So pay off high interest debt early. If we think about sole traders, for example, you may, or a limited company, you may have a credit card facility that you wish to call upon every so often, and normally the terms on them are very unfavourable. So always try and pay off the high interest debt early, and continue to maintain the controllable debt that you're servicing. So if you've got a business loan, for example, that's on favourable terms, then obviously that's routine payment, that's easier to control than a credit card liability, for example. And ultimately, if you need to continue to dip into that resource in terms of liability or business loans, or continuing to have debt funding, you need to have a good credit score. Otherwise, you're just going to make it more difficult to raise those funds. So maintaining a good credit score on a personal and a business side is very important. Ultimately, if you're a director of a limited company and you've got a very poor credit score, that will reflect in the business, because the lenders may consider the director's financial circumstances as well as the business. And I suppose one thing that we work with people on is protecting the business and the owners. So insurance to cover business interruption, key person cover, and liability insurance. So thinking about certain areas, for example, death in service cover for your employees if they were to pass away, income protection for yourselves, for business owners or key members of staff, for example, and legal structures. So it's very easy in the early stages of setting up a business to just sort of get things set up quite quickly and just get rolling. But ensuring that you have a business continuity plan, ensuring that there's a solution if things don't pan out as expected, if you fall ill, or if there's more than one party involved, more than one director, or you're in a partnership, making sure that that ownership has a clear structure in place, and that any scenario can potentially be covered, and there's a clear plan in place for how to reconcile that scenario, be it illness, death, or disagreement. There we go. So planning for growth and unexpected events. So in terms of the situation here, set smart goals. So when we're setting up our goals, let's make sure that they're specific. And then, for example, 10% revenue growth in 12 months. If you leave it too open-ended, you'll effectively have nothing to benchmark against, and nothing to track, and not measurable. Reinvest profits into the business effectively. So when we think about areas like marketing, staff, or technology, trying to make sure that you're investing in areas that can make a considerable difference to your business. Consider funding options for expansion. So if you're planning on expansion, make sure that you're considering all the options. Sometimes it's the injection of capital that's needed to help you expand, not the ability to service clients or the income stream that is already there. Sometimes you need that little boost to get you to that next level, and plan for unexpected events. We've only got to look at the last 5 years. Well, the 5th anniversary being in the last month. Things like COVID, and economic downturns, high interest and high inflation environments that we've seen since February 2022, can have a significant impact on businesses. So review and adjust costs quickly if there's an economic downturn. Have a succession plan in place for key staff if they leave, because ultimately, if that person is integral to the business, you have to make sure that they're replaceable. And having something like key man cover, insurance, for example, if they were to fall ill or sadly pass away, may be sort of the financial protection that's needed for the business to be able to replace them. And legal disputes, so ensure contracts and agreements that you have between business owners, staff, and third parties like contractors and suppliers. For example, make sure they're watertight so that there's no ambiguity or issue if they're ever called upon. And I suppose that the bit that sometimes we can significantly overlook is making your business pay you back. Ultimately, we don't all get into business to drive one particular social change or with one thing in mind. Ultimately, we're working to be paid. So the business at some point, hopefully, once it becomes profitable and sustainable, will start to be able to remunerate you. I've heard it too many times to count. My business is my pension, but actually, the risk there is that you're relying too much on the sustainability of your business. The business is far too ingrained in one industry and cannot adapt, and then suddenly the business might not be what you expected when you get near or at retirement, and it might not be sellable to the value that you were hoping. So sometimes remunerating yourself throughout your life as a business owner or sole trader is the most important thing you can do to prepare for the long term. So it doesn't have to be pay, but pay in line with your needs, or importantly, in line with expectations. P11D benefits also. So some things that you may typically hear about is company cars or health insurance to protect the family, for example, are all things that a business can potentially pay for. Yes, you may have an income tax liability with those benefits, but they can be very helpful in terms of covering a cost that otherwise you'd have to cover personally. The one that we love to bang the drum for is making employer contributions to your personal pension. So remunerating a director, for example, from a limited company, a personal pension contribution can be made in lieu of salary. So the main advantage here is a pension contribution is a business expense. So in that regard, it reduces potentially your corporation tax liability and your profit, but that money is now in a personal pension in your name. So ultimately, the business has transitioned that money from business wealth to personal wealth, and provide protection for you or your family in the event of illness, injury, or death. So death in service, key man protection, shareholder protection, or relevant life insurance are all sources of protection that can be set up by directors or businesses or sole traders to protect the people within the business, and ultimately, if the worst case scenario was to happen, potentially provide a payout to maintain the lifestyle of you or your family in the event of death or illness. And yes, these all come at a cost, but I suppose what we've got to do is get ourselves to that comfortable position and then start to think about your personal needs in the future and plan for this, and plan for how the business can provide this for you. Otherwise, you're just going to continue to work yourself into a corner, in the sense of the business will grow, but financially you'll be in a position where you're not being appropriately remunerated throughout your journey. In terms of being paid out from a business, it's the more parties there are. So normally, if it's a single director or sole trader, we tend to give this even less attention than if we're in a partnership or a limited company with more than one director. Normally, because the sharing of profit between more than one party is discussed and is more in focus, rather than if we're a sole trader or a single director limited company, we tend to just sort of plow on regardless. But actually giving your personal needs the care and attention is very important. So the final takeaways from section 6 is review financial plans annually, adapt as the business grows, potentially work with professionals. Accountants and financial planners can help in their different capacities. Have a contingency plan, be prepared, and protect against future risks, and use financial forecasting tools to stay ahead of challenges. So when we look at resources that may be able to help, so we've covered a lot of things already in terms of different resources, but when we look, we've got things like Live Plan, which can be used in addition to all the resources previously mentioned, to help with business forecasting and strategic planning. And then things like business analytics and decision making. You can use things like Chatter AI to help you connect with, help be a chatbot to connect to accounting software, and even things like ChatGPT can be used to help you in terms of interrogating your position and giving you a sounding board to work off. Okay, so in the resources, and the last bit for today is a little financial health scorecard. So just before the conclusion, we've got a few minutes left. So this is effectively a scorecard to help you understand where potentially your business is now, and to potentially use in the future to help understand how much your business has progressed in the last in the following years. So these are all expected to be scored from 1 to 5. So when we look at this, there's 15 questions. So these first ones will be based on the business, and then there's some based on your personal circumstances as well. So if you look in the resources, you can see all of the questions together, and then if you score from 1 to 5, 1 being effectively nothing, 0 or no ability to cover this, or 5 to be exceptionally confident that this is covered, that you've got that in the bag. So if you work through those, giving yourself a score from 1 to 5, and then what we'll do quickly in a couple of minutes is we'll go to the next page 2, which is the personal bits, and then we'll look at how that pans out in terms of the scores. There's three categories depending on what you score. So we'll run through those in a minute. So I'll give you a couple of minutes to have a look at those. Let's quickly run through the 10 questions. So, do you have a clear and up-to-date business plan with financial projections? Number 2, is your business consistently profitable with a steady cash flow? Do you have an emergency fund for your business to cover at least 3 to 6 months of expenses? Number 4, are your business debts manageable and aligned with your revenue and growth? So, question 5, do you regularly review and update your financial statements? So your profit and loss and your balance sheet. Have you clearly separated your personal and business finances? So this is especially important if you're a sole trader. So have you got a personal account and a business account, for example? Are you taking advantage of all available tax reliefs and allowances for your business? There's question 7. Question 8, do you have systems and processes in place to manage invoicing and reduce late payments? Question 9, is your business insured adequately to protect against risks and liabilities? And last question on the business side, number 10, are you confident your business could operate without you for an extended period, e.g. due to illness or other circumstances? Okay, so let's quickly move on to the next one. So this is to cover off sort of more personal questions, so less business related. So question 11, do you have a personal emergency fund cover at least 3 to 6 months of living expenses? Number 12, do you contribute regularly to your retirement savings? So this can be a pension, which would be the normal route, but it can also be ISAs, for example, or similar investment strategies. Number 13, are you on track with any personal financial goals? So maybe you're planning to pay off your mortgage, saving for education for the children, or whatever it may be, but are you on track for those? Question 14, do you have appropriate life insurance, critical illness cover, or income protection in place to cover those sort of eventualities and protect yourself or the family, importantly? And 15, do you regularly review your personal financial situation and adjust your budget as needed? So again, score them from 1 to 5, 1 being little or nothing in regards to having something in place, or number 5, saying that you're very confident that you've got that covered. And as I say, these 15 questions are in the resources, and there will be a flyer that goes out afterwards with these, so that you could sort of do this separately, or do it as a routine sort of scorecard to check how you're getting on. So I suppose hopefully, if you've answered those 15 questions, you'll have a score out of 75. If you've scored it from 1 to 5, and we've categorized that into 3 areas. So if you've scored between 1 and 25, high risk, so the financial health of your business and yourself maybe requires urgent attention and action. 26 to 50, moderate risk, so progress is being made, but there's room for improvement. And then the last category, 51 to 75, healthy, your financial health is strong with some opportunities to optimize potentially. So what we'll do is quickly run through the 3 outcomes with an action plan, and then we'll go from there. So action plan. So if you're in the high risk category, you might need to, many of these we've covered in the webinar today, but just to reiterate some of them: identify and eliminate unnecessary expenses, start building a cash reserve, aim for at least 1 month's expenses initially, prioritize high interest debt repayment, business profitability, so review pricing, revenue streams and cost control measures, separate out your finances, review your insurances both from a professional and personal point of view, potentially seek professional help to ensure that you're on the right path, and importantly, plan for retirement. So have a goal in mind, and start to implement small and regular contributions. So your focus at the moment is on creating a solid financial foundation before you start considering investing for growth. So making sure that the business is sustainable and that your needs are met. So if you've hit the moderate risk, so you're between 26 and 50 out of 75, this is more about refining and improving. So refine your budgeting, so improve tracking of income and expenses, increase the savings to that between 3 and 6 months, ensure debts are under control, start planning in terms of using tax efficiency from a business and personal finance point of view, retirement contributions, so back to section 6, making sure the business is remunerating you appropriately, insurance check, so make sure that from a business and personal point of view you've got everything covered, and then business resilience, so making sure that if that proverbial curveball's been thrown, that you've got it covered. So the most important thing here is start to work on financial efficiency, risk management, and long-term wealth building. And then lastly, if you've hit the green dot in terms of healthy, it's more about growth, security, and optimization. So maximize investment, potentially expand on retirement savings, business growth strategy, so identify new opportunities and scalability, succession and exit planning. So starting to think about how you can exit the business and how that can work for you in the long term. It may even be short term, but making sure that you've got a plan in mind. Of course, plans can change, but if you've got something in mind, you've got something to work to. Tax efficiency, so a bit like if you're in the moderate one, optimize your tax strategies, estate planning, so from a personal point of view, making sure your wills are in place, potentially looking to use trusts, having a power of attorney in place for long-term security, and then lifestyle planning. So you've potentially done a lot of business planning, but starting to plan for your life with and after the business, so that you align your business success with your personal goals. So at this point, you're leveraging the financial strength of the business for long-term wealth building and security. Okay, as I say, all of that is in the resources tab. So potentially you can do that afterwards if you didn't have time to run through all 15 questions. Okay, so a recap of the key points: business structures and record keeping. So choose the right setup. You may at the moment be a sole trader and looking to turn into a partnership or a limited company, for example. But pick the one that is right for you, and importantly, maintain accurate records. Budgeting and forecasting to plan revenue, expenses, and avoid the common pitfalls. Cash flow management, so essential for business survival. Use forecasting tools and best practices. Obviously, there's a number of resources in the slides that you could potentially interrogate. Financing your business, understand the options available to you, how to prepare for that in terms of whether it's a grant or debt financing, and importantly, make sure you're ready and comfortable with that as a decision, and that you are happy with the consequences of taking on new partners, for example. Tax and compliance, always stay on top of your key deadlines and avoid those penalties. And importantly, avoid getting in the HMRC's bad books. And then long-term financial planning, build resilience, plan for growth, and protect against risk. And then strong financial planning is the foundation of business success, is our key takeaway today. Okay, so just to quickly cover off the tools and resources. So as mentioned previously, accounting software, Xero, QuickBooks, Free Agent, for example, cash flow forecasting, Float, Excel templates are still wonderful if you don't want to implement additional costs. Business planning, so Gov UK's Business Finance Support Finder, for example, and all the other bits mentioned previously. Where to get support, so you've got your local growth hubs, Kent and Medway, for example. You've got financial advisors and accountants if you want professional help, and then naturally there's a myriad of information on the Gov website, gov.uk website. So if you put gov.uk/business, there's tons of resources there, including PAYE and HMRC resources as well. So the next steps in terms of your call to action: apply one key financial strategy from today, be it investigating one of the resources that's available, or trying to work towards, say, for example, that building up that emergency provision. Review your business finances in the next 30 days, and importantly, reach out for professional guidance if you feel you need it. Okay, thank you very much for watching today. If you've got any questions, as Vicky mentioned earlier, there is the Q&A, and my contact details are there if you want to contact me directly.
That's great. Thank you so much, Oliver. I really appreciate it. Wow, there's a lot to go through, but I just think it's great access to have that much resource to your hands. I think that's something that's really come across, is the fact that it's good just to delve into those individual areas that we all should be looking at regularly, that we're all just busy running our businesses at the end of the day, and you sort of lose focus. To have this time to sort of see it in black and white and start to really think about the health of a business, it's invaluable. I just say thank you so much again, Oliver. Really appreciate it. And this will be the end of a recording. So thank you for watching.